How do we manage through this constant, everyday drip, drip, drip of trade headlines while just trying to preserve assets and make money for Credit Suisse's clients?
I mean, I think with trade, I think you need to put the conversation in a broader context. And in reality, what we're talking about is issues which matter in terms of safeguarding intellectual property, equal access to markets. And then I think there are some issues which are on the table and then get taken off the table. And I think that's where you need to sort of separate what the real conversation should be and then the issues which happen to get batted around from time to time.
What should the real conversation be right now?
Well, I mean, I think if we can honestly protect the intellectual property of the U.S. and guarantee equal access to markets, I think that's something that's worth fighting for, and that will ultimately be better in the long run. If it's simply a matter of shifting soybeans from Brazil to China, I'm not necessarily sure that benefits the broader economy. Sure, local farmers will prefer that, but from a solution to the broader issue, I don't think that's it.
Okay, so in your recent note, you guys at Credit Suisse, you argued that cyclical changes to taxes may be more important than trade or economic headwinds. Please explain.
Well, I think what happened is, just taking a step back, we had the tax and spending bills that went into place following the election, and we had a ramp up in economic activity following that. So we suggest that rather the deceleration we're experiencing now is simply a reflection of the fact that we are cycling that tax and spending package rather than a material impact from the trade and tariffs. And the easy way to look at it is, what were economists expecting 18 months ago to what are they expecting now for, let's say, 2019 or 2020 growth? The answer is expectations are dead flat. So what we're seeing is a deceleration that was expected by economists because of that tax and spending bill, rather than necessarily a metastasization from the trade and tariff discussion.
But what does that mean? What do I do? Do I sell everything I own? Do I buy more stocks? What's the solution?
I think right now what's important is we've started talking about what is called a semi-recession. That is an area where the industrial data is decelerating materially, but it's not broad-based in the sense that we don't expect a economic recession. I think that's important.
What's the difference?
Well, I think, it doesn't impact teachers. It doesn't impact government workers. It only impacts what is currently about 10 to 15% of the economy. So the industrial data slows down, but yet everyone else, services, still continue to do very well. And I think that's how we can have situations where we have growth in areas like Google and Facebook, but then we have areas in the cyclical component where...
So bottom line, it sounds like what you're saying is, yes, the industrial data, the manufacturing stuff is slowing down, but you do not expect that to create a broad-based macro recession in the United States.
That's 100% correct, yes. And investors, what they want to miss is they want to miss that recession. Absent a recession, equities tend to go up. And I think there are portions which do better. I think areas which have more growth. Areas
Quickly,
which are
what
more
areas
defensive.
are going to do better and have more growth?
Technology,
20 seconds.
Communication services, those are areas where those businesses are generating their own success. Avoid anything with economic cyclicality: industrials, materials, energy, financials.
All right.